This is Building Lifestyles, a show designed to help everyday Australians create a lifestyle that inspires them using property development strategies. On the show, you'll hear from everyday people changing their lives doing property development. You'll learn from their successes as well as some of the challenges they've faced along the way. We also talk to experts from a range of fields who share specialised techniques that you can use to accelerate your property journey. I'm your host, Amanda McEwen, and I'm the founder of the Rising Star Developer. And I'm really passionate about helping everyday Australians build lifestyle using property development. Welcome to today's episode. I'm thrilled to have special guest Tyron Hyde, the founder and CEO of Washington Brown, one of Australia's leading property depreciation and construction cost consulting firms. With over 25 years' experience, Tyron is widely recognised as a trusted expert in property depreciation, having authored the book Claim It, and is a regular speaker at property investment seminars and events. His knowledge and insights have helped countless investors and developers maximise their returns. Today, Tyron will be sharing valuable tips for property developers on how to optimise their projects, reduce cost and enhance profitability. So welcome, Tyron.
Thank you very much, Amanda. That's a very lovely intro.
Now, you've got your own podcast, which is called 10 with Ty. So you ask your guests the same 10 questions, and I'm going to be on your podcast in the new year, so I look forward to that. So what we're doing today is I'm going to flip it around, and I'm actually going to ask you the 10 questions that you ask all your guests.
Okay. All right, cool. That's 10 with Ty.
It is 10 with Ty.
Okay. All right. That's good. Let's do it. I didn't see that one coming, Amanda.
All right. So let's get into your first question. So what is your best investment?
Okay. So because I haven't thought about these, obviously, doing the podcast, thinking, what did I answer? In my head, I said, it's my podcast. If I want to have two answers, I can have two answers. So in this case, I might have two answers. The first one, from a property point of view, was my first investment. I was a project quantity surveyor on behalf of the bank at a job in Balmain. And I started with nothing, Amanda. I saw my father lose all his money, which is why I actually started this podcast. I want to leave something for my daughter because I've done okay, and I thought I want to pass on some of the knowledge from some of the skillful people that I've met in my life. But in terms of financial, the best investment was the first project that I was involved in Balmain. It was a one-bedroom unit that I bought. I was the QS on that job, and the developer went broke, and I bought an apartment off the plan for $1,000. I put $1,000 down, and the builder went broke. And so we project managed the job out. It took about 3 years to completion after that. And as a QS, I had to manage down to the subcontractors getting the building done. 3 years later, when we settled, the property had gone up to so much value. The bank lent me the money without having to borrow any money. So immediately I made already like $150K equity in the project from that $1,000 down. So my return on equity was huge, right? And so that was, from a financial point of view, was my best investment. From a mental point of view, I'd have to say my degree. I wouldn't be where I was unless I did a construction economics degree. And I wrote a thesis on the topic of property depreciation back in 1992. I'm showing my age now. 1992. So nearly 30 years ago. It's 32 years ago. And without that, that wouldn't have never enabled me to have the business that I have, the life that I've created, the wealth that I've created, and to have something called, in my post-nominals, an FAIQS, which is a Fellow of the Australian Institute of Quantity Surveyors. That's what the S stands for. These days, I feel like it just stands for friggin' old bloke, but I'll take Fellow of the Australian Institute of Quantity Surveyors. So combination of that lesson into property and also the education that I got from my uni degree.
Yeah, and it's interesting. So with all the amazing guests that you've interviewed, has education been a very consistent theme?
Absolutely. That has probably been the overarching theme of investing yourself down to invest in knowledge courses. The amount of money someone like, Dale Beaumont, I think he was on the podcast, he said something, he'd spent like $500,000 on self-education. The funny thing is with the podcast, I didn't expect so many different diverse answers. And funnily enough, no one's actually said their uni degree yet, which I was surprised about. But a lot of people that when they went to uni, there was HECS involved and it wasn't as expensive, right? So I would have thought pound for pound, uni would have been kind of up there. But the diversity of answers has been phenomenal.
Yeah, funny you mentioned that because I did a commerce degree many years ago and I've probably spent over 150,000 plus on my education. I continue to invest in myself every single year, but I think it's the education that I continue to do each year that continues to be an amazing investment. It's a gift that keeps on giving, right? You learn it once, but then you apply and you keep learning it and you grow knowledge as you go along. All right, question 2, what was your worst investment?
Okay, this is a no-brainer for me. Twice in my life, I've lost I say the GDP of a small African nation. And it was purely by gearing into shares. I wanted to be the richest man in the grave, Amanda, and I damn tried hardest to get there, let me tell you. And then when it was the first time was in the tech crash, I look back and I think, how on earth was I thinking that these companies that have no earnings were trading on 1,000 times income, not even profit, right? And yet you were able to borrow against that back in the day. And so I just thought, and when the market goes up really well, your returns are magnified. But when it goes badly, it goes back down. The same thing happens in reverse. And so both times I had to sell everything, lost the bomb. And so my number one tip to anyone investing, whether it be property, shares, everything, never ever gear into shares. Never borrow money for shares. If you can't own a share outright, don't own it. That would be my nut. Because what happens is when the market goes down, people get margin called. And you have to either put in to keep it, otherwise the bank will just might liquidate you. So you have to keep putting in or sell shares, or you have to put in bucket loads of cash. And even though they might be good stocks, what happens is the momentum goes on and everyone just piles in or piles out. And so the price can plummet. So that would be my number one advice for people is never ever borrow money to buy shares.
Remember, same thing, the old margin loans.
Yeah, that's what they were, yeah.
Margin loans, yep. I got bent with those as well and bought a heap of shares and got margin calls and had to liquidate. And fortunately, we were able to do that. But that was a very expensive lesson in share investing as well. So I hear you there.
Yep.
Okay, question 3, your most valuable investment advice.
Okay, this is a good one. So it's actually one of my clients is Harry Triggerboff. And he's one of the richest men one of the richest people in Australia. He's got $27 billion worth of wealth. Put in perspective, the last 4 years, I read an article and he earned $1.5 million per hour, right? So when he invites me to lunch for 2 hours, I get really scared he's going to send me an invoice the next day. But he hasn't yet. But he said to me once, he said that lunch, he goes, Tyron. He goes, and he speaks like this. He ends his sentences with a higher intonation. He said, Tyron. I said, yes, Harry. He said, do you want to know the secret to my success? I'm not going to say no, Amanda. Yes, Harry, what's the secret to your success? He said, listen to me. He said, when times are bad, I buy land. By the time I get development approval, which would be 2 or 3 years for Harry, times are good again, right? So when times are bad, I buy land. By the time I get development approval, times are good again. What does it mean? It means do the opposite of what everyone else is doing. Yin when others are yanging, right? And so the secret with Harry is that it's not a question of whether it's not a question of whether you time the market or have time in the market. For someone who, like Harry, who buys the land, develops it over a long time period, and then keeps half the stock, he does both. He times the market because he's got so much money, and then he has time in the market because he holds his stock. And if you do that, Amanda, I think you found the holy grail.
Yeah, that's very similar to what Warren Buffett's words of wisdom, isn't it? Be greedy when others are fearful and be fearful when others are greedy. So it's interesting to the very wealthiest men with a very similar philosophies. And it's interesting because having gone through the last few years in development, I've been developing for, over 10 years now. And especially during the bumpy post-COVID world where the market was going up and then there was building prices were going up and there's been a really challenging time in the last couple of years, they've actually been the most profitable for me personally. So I've experienced exactly that as well, where when people are standing out, waiting on the sidelines, waiting for the market to turn or waiting for the perfect market. And if you're in the market and making the most of the time when others are fearful, it certainly has provided an opportunity. And you see it, most people have been in markets, they tend to make the most money when the markets are down and everyone else is fearful. So really interesting words of wisdom there.
One time I was at a property conference, I was exhibiting there, and it was at a property expo, and there was like 500 people lining up to get into a property expo. And I thought, this is crazy. That was a good time for me to sell some of the stock that I had that wasn't, those that are hard to sell when it's, the market's not, when the market's booming, you can sell anything, right? But when it's like, so I thought, this is it. I'll just get rid of a couple of those because if you're lining up, 500 people lining up to a property expo, something's wrong.
Yeah. So true. Amazing. So your question 4 is, what is your ideal portfolio mix?
Well, that is a very good question. I've actually been a bit surprised that the answers of this hasn't been as detailed as I thought. Like, obviously, I've had people from properties in, property shares in, and they've been pretty much focused on what they do, stick to their knitting, which is understandable, I guess, if that's what you know. Sometimes I wish I never touched shares. But for me, look, I'll tell you more my mix, which I'm pretty happy with at the moment. I stayed out of crypto. I missed that boat. But I've got probably about 50% in property, residential property, probably about 10% in commercial property, about 25% in shares, and about 10 to 15% in cash for that day. So for me, that's a pretty reasonable. It has fluctuated, but what I also then do, Amanda, is then I recalibrate every year. So I look at it and say, okay, I've got a commercial side might go up to 20. I go, oh no, I just want to leave that at 10, and then I might move some of that around. And when I say commercial property, a lot of that is within commercial funds. I've owned offices and so forth, but I've sold all them now. I just have commercial funds because at one point there, they were trading so ridiculously low to the NTA, which is a net tangible asset backing. You're buying listed property funds at half price of what the valuations were, right? Because the market just deemed that was what the price should be. They've changed now. But so, yeah, for me, so I tend to like about 50% residential property, 10% commercial, 30%, 25 to 30% in shares, and about 10 to 15% cash for a rainy day.
Yeah, which is always important. You've got to have that buffer sitting there tucked away in case you need it, that's for sure.
Yeah. So that's for me. It's a pretty safe, like having half in residential. I don't have a lot of gearing, I've got to be honest with you. I've just been pretty lucky. So I've, well, you make your own life, don't you?
Yeah, you do, absolutely. Yeah. That's funny. The harder you work, the luckier you get for some reason, isn't it?
Well, that's the other saying, isn't it? The more I practice, the luckier I get. Was a quote by Gary Player, the golfer. The more I practice, the luckier I get. That's one of my favourite quotes.
And it's so true. And I think having a balanced portfolio it's like the saying, you don't want to have all your eggs in one basket, do you? So you always want to try and have multiple different income streams. So if, for example, the share market is tanking, you've still got income coming in from other streams. And I actually love whenever the market tanks in the share market. I mean, I've got a share portfolio as well. That is whenever I see the headlines go, share market tanking, my husband and I go, okay, awesome. How much we've got to buy? Like every single time we see the headlines tanking, share market tanking, that's whenever we buy. So similar to the philosophy you mentioned earlier, I guess, about the ideal investment advice.
Well, the thing is with shares, I guess, is that you do have these wild fluctuations a lot more than you do in residential property. And so you can kind of see, if the market goes down 2%, generally good indication that's, it's gone down 50% once, I think 87, but if it's 20% drop, you're going to be pretty safe-ish to have a punt, I reckon.
Yeah, absolutely. And then I think it's also, I'm not sure if you do the same thing as well, Tyron, but I always look it up with our portfolio mix. We're also looking at the stage of life we're heading into and thinking, okay, what do I need to be adjusting here?
Yes.
Do I put more on my self-managed super fund, or do we boost up our shares, or do we build more developments or buy more assets? So we're always thinking about that, because I guess the portfolio mix also changes depending on the stage of life. For example, you think about buying properties, whether it's for family members or, leisure. So when you're buying a property, whether it's for an investment or whether it's for a personal leisure or asset to help somebody else. So they're very different conversations and very different strategies depending on where you're at in the stage of life as well. So I always find that I reflect upon where we're at and adjust our portfolio mix accordingly based on that too.
And even within your portfolio mix of your shares, you start adjusting based upon your age as well. So at this age now, I have a lot more income shares than I would have if I was 30 years old, which would be far more growth orientated. But now I'm looking at in my super fund, having something that has the nice income because, the tax benefits there as well. So yes, you readjust basis. I guess you get a bit more conservative as you get older, which you should be, right? Because you start worrying, you go, oh, wait, I've got only this long to retirement, or if anyone retired, but I'm like, I better just make sure I've got some there left.
Yeah, that's right. Yeah, and have a bit of fun along the way as well.
Absolutely.
So your question 5, investing 20K as a 20-year-old.
Yes, yep. Okay. So there's been some interesting answers here, and some have been very good in terms of saying, 10,000 on a small stock portfolio and 5,000 on investing yourself. But I look at it from a different point of view. I look at it from because my daughter's now getting to close to that age. She's like 16 now, 16. So she might come up to me and ask me this question soon. What I tell her, I'd say, take $1,000, go and live in Europe for 1 year, and don't ask me for any money. Right? Because if you can live off $20,000 when you're 18 or 20 years old in Europe, right, and manage to survive, you're going to learn some of the best life skills you'll ever learn. And I did that. I came back actually $10,000 debt when I was about 21. But I really believe that I think the life skills that I learned at that age, living in backpackers and just trying to eat cheap and do all those things, kind of put me in good stead to be hungry for life and hungry for a passion and to want to create. Like when I was young, I'd be sitting in, a beach in America and seeing these guys there with overalls on, but selling ice creams or from their stomach, right? And I thought, geez, I could do this when I get back to Manly Beach. I want to start a business doing it. I didn't think about the laws, but my mind of thinking about all these things that other people are doing all around the world to try and bring that back and do that within Australia, right? Got me thinking. And I really believe that just going off and having that journey and making sure that money lasts will be a good $20,000 spent, if you ask me, as a 20-year-old.
Yeah. And what incredible life memories and experience as well.
Totally. And friends. But back then when I met friends, there was no Facebook, right? So you've lost all those friends that I met along the way that you would have Facebook friends now that you could keep in contact. No, never seen them again.
And that's so funny because I had a very similar journey because I did the same thing. I backpacked around as a 19-year-old, actually, just about to turn 20 overseas. And had to stay at the backpackers hostel, ask the extra rolls and butter into your backpack so you've got lunch provided, and the journey, the life experience you have. I can imagine that's actually a really good one. I hadn't thought about it from that perspective. Yeah, especially now, it's so easy to communicate. I had to fax my mum back to get my parents back to give them an update because you didn't have internet or mobile phone back then. So very, very different world. But that was a great response. I love that. Question 7, advice to your 20-year-old self.
That is a good one. I'd say back yourself as an investor. Do the complete opposite of what everyone is doing. That is the number one thing I would tell myself. Try and ignore the noise. There are other ways to make money. But if you, like at the moment, I see my Facebook feed, everyone go and buy in Perth, right? I would not be buying in Perth now because I just think the market is too hot. It's too hot. Whereas I look at the Melbourne market and I look at that and I look at the price differential between Sydney and Melbourne is at its greatest point ever, right? And so to me, I know the taxes there are a bit silly, but that could change overnight and that market will kick off if you ask me. So do the opposite of what everyone does is a good thing. Like I recently bought a truckload of Zip shares and because the market just having them so much to the point it was just ridiculous. No one wants them. And now they've gone pew like that. So ignore the noise, back yourself and do the complete opposite of everyone else is what I would tell my 20-year-old self. Yeah.
Very wise words. Your question 8 is, what legacy do you want to leave?
Well, I just want to, I hope people look back on me and believe that I've been a good person, an honest person. I created the quantity surveying industry in this country, so that's been a bit of a legacy for me. Also, this podcast for my daughter is a bit of a legacy, but I just want people to look back and think, he's a good guy. He made people laugh. He was an honest man. I'm a pretty good father, I believe. Loving wife. I've been with my wife since we first kissed when I was 16, man, and I'm now 53. That's a long time. And I've got friends that have been with me for 30 years. So I think that friendship that I've had is a legacy of bonds. Like most staff, the average length of Washington Brown employee is 14 years. So which in this day and age, like you're talking over medium-sized companies. So the legacy is that people just think I was a good guy, was honest and did his best, really.
Yeah. And hopefully your daughter gets to hear these podcasts and hear the answers to these questions as well.
That's the plan. I've just got to get her off Snapchat.
Yeah. Oh my goodness. Well, perhaps what you can do is actually weave some of the reels that I give you into Snapchat. She might be able to get it that way. I'm sure there's a way. I've got 3 teenage girls, so I absolutely hear you.
Yeah.
Okay, so what is your definition of success?
Well, that is it. That has been the hardest question for most people. Obviously, and it's changed over my time. I guess, as I said earlier before, I wanted to be the successful person in the grave, and that is definitely not being success. For me, the definition of success is, I guess, back to a little bit on the last point, is that I have an incredibly happy marriage, and we've been together since we're 16 years old, and I've got a beautiful daughter. That is, for me, the definition of success right there. I don't think that it can get much better than that. The wealth side of it, it's great, and don't get me wrong, I'm not going to give it all. I'd rather have it than not, but really the definition of success is my beautiful marriage that I have and my beautiful daughter.
Yeah, what a lovely, amazing response there. Question 10, best strategy not to lose money.
Okay, so there's been some good answers on this one. Firstly, let me ask why this question. This is the essence of the podcast, of why I started, because my father lost everything when I was growing up. I saw him, he invested, he was a cripple, my father, and he got retired early from the TAFE as a lecturer in psychology, and they gave him a payout. And he invested all his money into this company called Estate Mortgage, which was in the late 80s. They were advertising they were safe as houses. They were investing in bricks and mortar. What they were really doing was investing in mezzanine funding into development sites. And when interest rates went to 18%, 22% to developers, it fell down like a house of cards. And so he got after 5 years, like 6 cents in the dollar from the liquidators, and seeing him lose that money was crippling for him. Well, he's already crippled, but it crippled him more. And I think that's what killed him, not the stroke, but the sort of what you've worked for all your life, losing it. And $250,000 is a lot of money. It still is, but a lot of money in 1990. So he lost that all. So that's why I guess that's the reason of this question. There's been some very good answers here. I think Chris Gray, the property, gave a really good answer here in regards to blue chip properties, and he makes a lot of sense. If you're buying properties, and I know it's hard for everyone to do that, right? Not everyone can buy a unit in Bondi. I was just looking at a 1-bedroom unit in Bondi, just sold recently for $1.8 million for a 1-bedder, 45 square meters, like crazy. But his strategy is just to buy blue chip properties. Not always going to be the case. And the simple answer would be just invest in cash, but you're going to get eaten up by inflation, right? So you can't do that. So I think going back to the balanced portfolio that I had before, the residential would be a cornerstone of that. I would be saying a little bit of commercial if you have it, 25% shares and 50% cash. And the key here is recalibrating it all the time based upon, like if one shoots higher, we'll recalibrate it. And that would be one of the keys to not lose money.
Yeah, okay, that's a great response. How would you invest 500K as a 50-year-old?
Well, let me tell you why this story came about, Amanda. So I've got a big group of friends that there's about 30 of us that we meet up every year. And I was at about 2 years ago, five of us died, not us, not me particularly, but 5 died within that group, either through suicide, drug overdose, or heart disease. And I'm at our annual function to get together, I'm thinking, wow, look at all these guys here. As we're starting to pass on, some of their parents might start to pass away as well. And a lot of them haven't got a lot of money, financial sense. So, but they might have their families might have a house worth $1.5 million. They pass it on to the 3 kids. They might end up with $500,000 each, and they won't have a lot of financial literacy. So they'll probably hit me up and say, Ty, should we do with 500K? Because they don't want to pay for financial. So I've been thinking about it. I thought, well, what would I tell them? I'll probably tell them to put 25% into bank shares and just reinvest those dividends. They've got a long time still to have that. They're paying 6 to 7% in dividends, and hopefully there's a bit of capital growth as well. I'll probably say put 25% into an ETF on the ASX, so you do have the broad brush of the share portfolio as well, not just the bank shares. And I'd probably say put a bit into property, into probably a residential property in a regional location. And how I'd choose that regional location, Amanda, I wouldn't necessarily use a buyer's agency. What I would do is I would buy a report from Terry Ryder, Hotspotting. I would get the Herentide White Property Clock report, maybe a Residex report. And what I'd do is I'd create a heat map of Australia. And if all 3 say go and buy in Moe, Victoria, then I think there's something in that. And then I might choose a buyer's agency that works in that area. But first, I would find the independent area of where I think to buy in that regional location first. And creating a heat map of independent property experts who all they do is focus on where to buy would be my starting point.
That's amazing advice. So, and all those people you mentioned, they're very highly regarded, especially in the investment property space. So,
and don't make money on the back end of selling your property there. I think that's the key, right?
Yeah, no, absolutely. Now let's get into our bonus question. So, can you give the listeners one tip to take away from our discussion today that they can use right away?
Use right away. Okay, I guess the balanced portfolio that we've said, I think if you do have a mix of stuff, try and recalibrate it every year so that you don't, and that would generally lead you back to not losing all your money as well. Like you can, but the other number one tip, if you have borrowed for, I shouldn't give you financial advice, I'm not a financial advisor, but be very wary if you are borrowing for shares, if you've borrowed money for shares. Maybe sit down with your financial planners and do the math, because when I was investing in leveraged equities, the charts that show you how much money you can make when it's going well are great, and that's all you see. Well, that's what I saw. I never really saw the chart of when it goes down, so just be aware that you can lose a lot of money. And the other thing, oh my God, I don't know if you've ever got into it, but you have contract for differences, CFDs. Yeah, that's like leverage equity on steroids, where you can literally borrow. You only need like 1%. Which 1% down, right? And it can just magnify your returns both ways, even more so. So beware of those.
All right, no, sounds good. Now I'm actually going to add in another bonus question as I'm prepared here. So just to tie it all around to depreciation and what you do. So how does what you do actually help property developers to be able to optimize their projects, reduce costs, and enhance and optimize their profitability of their deals?
So, well, there's two folds with developers. What we do, there's the marketing side. So we get involved in from a development point of view, where if a developer's selling 50 units, or we work with a lot of the bigger developers, and when they sell a project, they want to show the investor, hey, if you buy this property, you can get a $15,000, $20,000 deduction and make it affordable, right? And which is really key for a developer to do that, because they need off the plan sales, a lot of them, in order to get funding. And unless they have those off the plan sales, unless they can show the investor that it's actually only going to cost them $50 a week as opposed to $300 a week, it'll be harder. It's harder for them to get those investors over the line. So that's where the depreciation report comes in. We also, we have a lot of developers that then keep their stock. And like as I mentioned before, Meriton is a developer that keeps service apartments and keeps blocks of apartments. And so once they've completed those jobs, we'll then itemise all those projects and the building costs and materials into a report that enables them to claim the depreciation based upon the tax laws for that individual type of property, but also that individual asset. Because things like service apartments have a different depreciation rate as opposed to a residential development. You're allowed to fast track a service apartment. I guess it's because there's more wear and tear. There's more people walking, more people using the lifts, etc. So there's ways of fast tracking it. And so a developer will come to us at the end of a project and say, here's all my costs, here's my design, here's my council contributions, try and save me a lot of money. And that's what we do.
Okay, amazing. No, that's fantastic. I just wanted to make sure that everyone understood what you did and how that can actually help them as well. So thank you so much for your time today and sharing your insights. It's been a bit different from what we normally do, but I think you shared so many pearls of wisdom there. They're going to help people in various different ways. And certainly if anyone needs any assistance in the depreciation side of things, we'll have a link to your details in the show notes. But thank you very much. And I look forward to having these questions asked of me.
Yeah, no, now you've got time to reason. I guess I don't have a lot of excuse, because I have asked these questions a lot, so I have been thinking about them. But you got me on the hop there, but that's good. No worries.
You did well. You thought well on your feet. So thank you so much. And bye for now. Thank you so much for listening. This is Building Lifestyles, a show designed to help everyday Australians create a lifestyle that inspires them using property development strategies. This podcast was produced by the Rising Star Developer. We've been helping Australians realise their financial and lifestyle goals since 2020. We play a pivotal role in educating, supporting and celebrating the goals and successes of our students and our community. To find out how we can help you realise your property, wealth and lifestyle goals, head to our website www.risingstardeveloper.com.au. To make sure you don't miss an episode of Building Lifestyles, be sure to subscribe to and follow the show in your favourite podcast app. And while you're there, leave us a 5-star review, as it really helps others find the show. I'm Amanda McEwen, and we'll be back next episode with more tips on how you can build your lifestyle.